Meet Diana Thompson. At 3:15 a.m. on October 12th, a drunk driver plowed into her parked 2018 Honda Civic. The good news? She had full coverage insurance. The bad news? Her $10,000 car became a $5,000 check, leaving her stranded and $5,000 short of an actual replacement. This isn't a random accident. This is mathematics designed to extract maximum profit from your loss. Today, we're going to decode the exact formulas insurance companies use to transform your real losses into partial payments, and how to rewrite the equation in your favor. The problem starts with three letters that cost Americans $8.3 billion in unpaid claims last year. ACV, actual cash value. When Diana called her insurance company, they didn't mention those letters were hidden in her policy on page 42, section 6, subsection C. Let's examine the exact mathematics they use to cut her payment in half. First, insurance companies start with the replacement cost value, what it actually costs to buy the same car today. For Diana's 2018 Civic in October 2023, $10,400. Then they apply their depreciation algorithm, not Kelley Blue Book value, their own internal depreciation tables. Diana's car lost 48% of its value in their system, despite local dealers selling the same model for $10,000. Here's where the system breaks. The insurance company isn't measuring real replacement costs. They're measuring theoretical value loss, even if that theoretical value has no connection to actual market prices. Let's decode the three major failure points in their system. First, depreciation tables. Insurance companies use standardized depreciation rates that ignore real market conditions. During the 2022 car shortage, used car prices increased 28%, but insurance ACVs kept dropping. Second, market isolation. Their formulas pretend each car exists in a vacuum. They don't account for local market conditions, supply shortages, or regional price variations. Third, replacement disconnect. The formula completely ignores what matters most. Can you actually replace your car with their payment? The math says no. Now, let's rebuild this broken system. Here are your 4 technical countermeasures. 1. Policy modification. Request a replacement cost value rider. Yes, it costs more, typically 15 to 20% above your base premium, but it bypasses the entire ACV system. 2. Documentation override. Take photos of your vehicle every 3 months, document maintenance, create a paper trail showing your car's actual condition beats their depreciation curve. 3. Market evidence collection. When filing a claim, submit 3 local dealer quotes for identical vehicles. Force their system to confront real market data. 4. Arbitration trigger. Most policies include an appraisal clause. If their ACV is more than 20% below market value, trigger this clause. They pay for a third-party appraisal. Let's return to Diana. After implementing these countermeasures, she forced a new calculation. The result? A $9,800 settlement, enough to actually replace her car. The system isn't broken. It's operating exactly as designed. But now you understand its mechanics. You can see the gears. You can identify the failure points. And most importantly, you can rebuild the equation to work in your favor. Remember, insurance is mathematics, and mathematics can be rewritten if you know the formula.